Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about revenue recognition, why it's so important, how the new rules have changed revenue recognition, what the new principles are for recording revenues, and then starting to do some examples. We talked about Neal Construction Company. We walked all the way through all 5 steps with Neal Construction Company. And then we've been talking about Hanson Company. And with Hanson, we talked about 4 of the 5 steps, but we didn't quite get to the best part, which were the journal entries. So just as a reminder, let's go through these steps. We know there's a contract for Hanson Company because we see the contract's been signed. We can see that the amounts are there. What we've committed to do is in there. We identified the obligations. We're selling equipment. We're selling installation. We're selling a lease. We figured out the transaction price. Best guess is we'll really get that full $3 million. And then we use the basket purchase method to take that general transaction price, that $3 million, and break it down to each piece of the contract. And we came up with a table that looks like this. 3 specific obligations with their standalone prices. We got a percentage, and we got our amounts of the $3 million. 2.7-ish is going to the equipment, almost $300,000 going to the installation, and $60,000 going to the lease. Now that we've got those first 4 steps done, we're ready to do the best part, the journal entries, as we actually recognize the revenue. Now remember that the basic rule is, as we complete an obligation, we recognize the revenue from that part of the contract. But sometimes we can recognize revenue a little bit early. And to decide if we can do that, let's go back to our basic information. Remember that we've got 3 options to decide, can we recognize the revenue early? Or do we have to wait till we've finished the actual obligation? Number 1, does the customer get the benefits as they occur? Well, I don't get actually into the building until the lease is signed, so no. Do I get to use the equipment before it's built? No. Do I get to use anything until it's installed? No. So I don't meet that first qualification. Second, is this something already owned or controlled by the customer? No, they don't own any of this stuff until it's completed. I mean, we could argue that, well, once we've got the lease, we can start using the building before we get the equipment, but we've already broken that out as a separate obligation anyway. So I don't have to break down the revenue in a special way. I can just recognize the revenue on the lease when I get the lease done, and then the equipment as I get the equipment done, and the installation when I get the installation done. The last option, am I creating an asset that has no other uses? And again, the answer is no. As I go through the lease process or the construction process, the lease isn't going to be worth anything until it's done anyway. So I'm not creating an asset at all until it's done. The equipment I could sell to somebody else. It's equipment. The installation, I'm not going to get paid unless they're happy with the installation. So I don't meet any of the qualifications for early recognition. I'm just going to have to wait until each piece is done. And for most companies, that's how it's going to work out because that's what FASB intended. So because each one has to be recognized as we go, we're just going to do the journal entries for each obligation, and we'll do it in the order that they're going to be completed. So first is the lease, and then the equipment, and then the installation. So this is obligation number 1, the lease. First obligation because it's the first one to get done. We'll just assume that this started on January 1, let's say of year 5, just to be different. And it's going to take me 3 months. So from January 1 to 3/30 of year 5, I'm going to record costs, and I'm going to create a contract asset for $10,000, and I will have a lot of different entries that get me to that $10,000. And in this case, it's probably just cash and wages payable that will get me to that $10,000, because it doesn't make any sense that I would use inventory creating a lease. This is the cost of creating or generating the lease. And then on the 30th of March, when everything is signed, sealed, and delivered, then I will recognize my revenue. So the revenue was $60,000 for the lease. And in this case, I don't have an unearned revenue or a contract liability because they haven't given me anything. What I have instead is accounts receivable, because they owe me this. I've done the work for them. I recognize the revenue. They're going to have to pay me. You can call it cost of goods sold or cost of sales. Either way works. And we'll get rid of that contract asset at the time that I recognize the revenue. Recognize revenue on lease of warehouse. My next obligation is the equipment. And the equipment, just so we've got the number, it's $2.67 million. And if we go back again, it's going to cost me about $1.7 million to produce it. So those are the two numbers that I need. So this is obligation number 2, the equipment. Once again, it's going to take me 6 months, and over those 6 months, I'm going to have a bunch of different entries for the cost of producing this inventory. Wages payable, raw materials, etc. And that was for $1.7 million. Cost of producing machinery. And we'll say that this is under contract, just so we do know that what I'm making is part of this process. At the end of June, when everything is done and I'm ready to give this to them, then I'm going to recognize again sales revenue, this time for $2,670,000. They haven't paid me in advance, so this is going into accounts receivable for now because they owe it to me. And I'll recognize cost of goods sold or cost of sales for that $1.7 million. And now that I'm shipping it to this client, now I'll take it out of the generic inventory account. Completion. Ooh, that's very ugly. Sorry. Completion of inventory under contract. And as I'm making these notes, I probably would reference the contract just so that I've got that information if I need it. Last piece is going to be the installation. So let's go back and get the numbers that we need first of all. The installation typically costs $100,000, typically sells for $300,000. I don't care about that. All I care about is the $100,000 here and the $270,000 that's the amount of this contract that's allocated to that process. And with those numbers, I'm ready to do the journal entries for obligation 3, installation. And in this case, all the costs will occur in the month that I'm actually doing the installation. And again, in this case, there's nothing inventoriable. I couldn't sell this to anybody else. So I'm back to using a contract asset account. And we said the cost would be $100,000. And that would be cash, wages payable, and probably supplies would be the other account that I'd use. Cost of installing equipment under contract. And finally, at the end of July, when everything's done, I would record my sales revenue. From our earlier table, that was $270,000. They haven't paid me yet. And then again, the cost of sales. We've used cost of goods sold in the past, and that's fine to keep using that one. I'll just use cost of sales just to show it. Has to be recognized as well. This is actually our third key concept. Costs have to be recognized at the same time that the revenue is recognized. Completion of installation under contract. Now that's really everything we have to recognize. We don't need to do anything else, but just to complete this, let's go ahead and show the last entry that will be involved. If everybody's happy, then on August 31st of year 5, 1 month later, we'll get the cash and clear out that accounts receivable. And then we're done. Everything's come together, all the revenue's been recognized, and we're good to go. You have now seen all of the basic principles with revenue recognition. Isn't that awesome? You know it all. But there are some scenarios, some different options or possibilities that might come up that maybe we need a little bit more practice with. So although we'll be using these same principles in the next few segments, we'll have some fun with them and see how we can tweak it, turn it, twist it to make sure that companies are recognizing as much as they can, but no more. We'll see you then. Thanks.